most people think the hard part of retirement is saving enough money. It's not. The hard part is not destroying it once you get there. Here's what actually happens. You spend 30 years building a portfolio. You hit your number. You retire. And then you spend the next 10 years slowly watching your account balance decline while convincing yourself it's fine. The market will come back. The plan said 4% was safe. And then it doesn't come back fast enough. And you're 72 and your options have changed considerably. That's the sequence of returns problem. And in 2026, with the S&P 500 trading at valuations that make serious people like Howard Marks, people like Ray Dalio, say out loud that we might be heading into a lost decade, that problem is not theoretical. It is very, very real. So today, I'm going to walk you through the 3 most common retirement income strategies people are using right now, explain exactly why 2 of them are ticking clocks in the current environment, and then show you the one framework I actually trust. Not because it's perfect, but because it doesn't rely on the market being generous to you right on schedule. Think of it like 3 types of retirement income machines. I'm going to keep coming back to that metaphor, the machine, because it captures something important. Every strategy is a machine. The question isn't whether it works, it's whether it works when the power goes out. Let's start with the most popular machine on the shelf, the index fund plus 4% ROO machine. You pile your money into something like a low-cost S&P 500 fund. You retire. You withdraw 4% a year. Done. Simple, elegant, backed by decades of academic research, specifically the Trinity study from 1994. Here's the thing about the Trinity study. It looked at historical rolling periods and concluded that a 4% withdrawal rate had a very high probability of lasting 30 years. Beautiful. Except it was using S&P 500 valuations and return expectations from a completely different era. Right now, the S&P 500 cyclically adjusted price-to-earnings ratio, the CAPE ratio, is sitting at levels that have historically preceded roughly 0% real returns over the following decade. JP Morgan has published research on this. It's not fringe analysis. When you buy expensive assets and then immediately start selling them to fund your living expenses, the math gets ugly fast. Let me tell you a quick story. There was a Japanese investor, let's call him Kenji, who retired in January of 1990. He had a solid portfolio, decent withdrawal plan, index funds, the whole thing. The Nikkei was around 39,000. He figured the market would keep doing what it had done. It didn't. The Nikkei didn't get back to that level until 2024. 34 years later, Kenji did not have 34 years to wait. Now, you might be thinking, that's Japan, not America. Different situation. And to be fair, yes, different economy, different demographics, but the mechanism is identical. You buy at peak valuations. Markets stagnate or decline. You're forced to sell shares at depressed prices to cover expenses, and each sale permanently reduces your future recovery potential. That's the machine breaking down under load. And here's a number that should make you pause. If you retire with $1 million and the market drops 40% in year 1, which it has done, 2001-2008, both saw losses in that neighborhood. Your portfolio is now $600,000. To get back to your original withdrawal amount, you now need to pull not 4%, but closer to 6.7%. You haven't changed your lifestyle. The math changed it for you. So, the 4% machine has a serious flaw. It needs calm weather to run well. And right now, the weather forecast is not calm. Let's move to the second machine, the income factory. This one's gotten very popular in the last few years. The idea is simple. Instead of selling shares to fund expenses, you build a portfolio of high-yielding funds, covered call ETFs, collateralized loan obligations, leverage closed-end funds, and you just live off the cash flow. Yield covers expenses. You never touch principal. Clean, mechanical, feels safe. I get the appeal. I genuinely do. It's like owning a rental property that pays you every month without you having to do anything. Except, here's the problem. A lot of these funds are the financial equivalent of a beautiful house built on a floodplain. Looks great on a sunny day. Ask it one hard question. Take covered call ETFs. Some of them are posting yields of 15 to 20% right now, and they've looked fantastic because we've been in one of the strongest bull runs in recent memory. Most of these funds were launched after 2020. They have never been stress tested through a prolonged bear market. A real one, not a 6-week correction. A sustained grinding 18-month decline with no quick recovery. When volatility spikes, the covered call structure starts returning capital to you disguised as yield. Your principal erodes, your income erodes with it. You're not collecting rent. You're slowly dismantling the building to heat your house. And then there are the leveraged closed-end funds. Some of these have jaw-dropping yields, 8, 10, 12% backed by pools of high-yield debt using significant borrowed money to amplify returns. Picture a guy running a convenience store. He's borrowing money at 5% to buy inventory he sells at 10%. Great business until the supply chain breaks. Inventory loses value and the bank calls the loan. Suddenly, he's liquidating his best inventory at the worst possible prices just to stay solvent. That is exactly what happened to some of the leveraged MLP funds during the COVID crash in 2020. Not to the underlying companies, those were fine. They had blue-chip balance sheets. They kept operating. But the leverage fund holding them margin calls forced liquidations at the exact bottom. Some of those funds were permanently impaired. Some closed entirely. This is where it gets really interesting, because the income factory people aren't wrong about the core idea. Cash flow in retirement is better than selling shares. The concept is sound. The execution in some of these vehicles is not. Now you're asking yourself, okay, so both machines have problems. What does the third machine look like? Let me tell you about a woman I read about once, a retired teacher named Barbara. She didn't have a financial advisor. She had a yellow legal pad and a rule. She would only live off dividends from companies that had raised their dividend for at least 10 consecutive years. Had a debt-to-EBITDA ratio she could verify and operated in businesses that people needed regardless of economic conditions. Utilities, pipelines, real estate with long leases, business development companies with strong underwriting history. Was her yield spectacular? No, it was solid around 6 or 7% on a blended basis. Did it keep up with inflation? Yes, because she specifically required dividend growth as a condition of ownership. Did it survive every market crash since? She built it. Yes, because the dividends kept coming even when prices fell. She didn't need to sell anything. That's the third machine. And in 2026, it's the one I trust. Here's the framework. I call it the two-pile system. Pile 1 is your foundation layer, diversified, lower volatility, dividend-growing assets that form the core income engine. Pile 2 is your yield enhancement layer, a smaller allocation to higher-yielding instruments that add cash flow but don't threaten the whole structure if one of them has a bad year. The foundation layer should do 3 things. 1. Generate a dividend yield that covers or nearly covers your core living expenses. 2. Grow that dividend at a rate that beats inflation over time. Call it 3 to 5% annually. 3. Be backed by businesses with durable defensive models that generate real cash flow regardless of economic cycles. Think sectors like midstream energy infrastructure pipelines that get paid on volume, not commodity prices. Companies with good investment-grade balance sheets and distribution growth built into their contracts. Think triple-net lease real estate, where tenants pay operating expenses and you collect rent with contractual escalators. Think utilities with regulated returns and long-term power purchase agreements. Especially now that AI data center demand has turned electricity into something resembling a growth industry. Think business development companies that have proven they can underwrite credit risk through multiple economic cycles, not just the easy ones. A fund like Schwab's U.S. Dividend Equity ETF ticker SCHD is a reasonable anchor for the foundation layer. Low expense ratio around 0.06%, roughly 4% yield. 10-year track record of growing that dividend at over 10% annually. More than 100 blue-chip dividend stocks across sectors. It's not flashy, it is reliable. Think of it as the concrete foundation before you add anything else. You add infrastructure and utility exposure on top of that. Then some mega, cap tech exposure through a well-constructed covered call ETF. Not as your core, as a complement, something like GPYQ from Goldman Sachs, which uses a dynamic sleeve that preserves more upside in bull markets than static covered call strategies. For the mini case study, let's say you're 58 years old. You have $1,200,000 to deploy, and you need roughly $7,000 a month in passive income to cover your expenses. That's $84,000 a year. You need a blended portfolio yield of about 7%. Here's how that could look. 30% in CHD, $360,000. Yielding 4% gives you $14,400 annually. 15% in a utility-focused closed-end fund, $180,000 at roughly 6.5% yield gives you $11,700 annually. 10% in GPYQ, $120,000 at around 10% yield gives you $12,000 annually. 20% spread across 3 or 4 quality midstream companies, $240,000 at an average yield of around 7% gives you $16,800 annually. 15% across 2 or 3 triple net revenue, $180,000 at around 5% yield gives you $9,000 annually. 10% in 2 or 3 business development companies, $120,000 at around 9% gives you $10,800 annually. Total annual income roughly $74,700. Blended yield about 6.2%. Not quite the $7,000 a month target, but close. And with dividend growth built into most of those positions, you're realistically at that number within 2 to 3 years without adding a single dollar. And critically, none of this requires the market to go up. Now, the machine isn't maintenance-free. You have to monitor these holdings. You have to check that dividends remain covered by underlying cash flows. A midstream company that takes on too much debt is a problem. A BDC that starts issuing shares at a discount to NAV to fund new loans is a warning sign. A REIT that's overpaying on acquisitions is a problem 3 years from now. This is not a set-it-and-forget-it strategy. Financial advisor voice, have you considered just buying the total market and letting it ride?
Yeah, I have.
And I've also considered what happens if the market's flat for a decade and I'm selling shares the whole way through. Thanks for your time. But you might be thinking this sounds like a lot of work. And to be fair, it is more work than buying one ETF. But here's the thing. You know what's more work than monitoring a dividend portfolio? Running out of money at 70 and trying to re-enter the workforce. Now, here's the reversal that most people miss. You think the problem with retirement income is finding assets with high enough yield. That's not the real problem. The real problem is survivability. Yield is easy to find. Walk down the internet and you'll find funds yielding 15 to 20%. The question isn't, can you find the yield? The question is, does the income machine still run in year 7 when the economy is ugly and markets are down 30% and your sequence of returns luck has been terrible? That's where the quality of the underlying businesses matters enormously. Enterprise Products Partners has raised its distribution for over 25 consecutive years, including through 2008, 2015's oil crash, and 2020's COVID collapse. Not because they were lucky, because their business model fee-based pipeline contracts is structurally insulated from commodity price swings. They get paid when the gas moves through the pipe. The gas moves through the pipe when people heat their homes and run power plants. People always heat their homes and run power plants. That is what a dividend machine that works in bad weather looks like. What 99% of people do is usually what not to do. And 99% of people chasing retirement income are either reaching for unsustainable yield in vehicles they don't understand, or they're clinging to the 4% rule on an overvalued index fund because an academic paper from 1994 told them it was safe. Neither of those is a plan. They're hopes dressed up in spreadsheets. So, let's come back to the hook. The hard part isn't saving the money. It's not losing it. And the way you don't lose it is not by finding the highest yield. It's by building a machine with multiple components across sectors and structures, where if any one piece has a bad year, the other pieces keep paying you while you wait for it to recover. Here are 3 things you can actually do this week. First, audit your current retirement income plan specifically for sequence of returns risk. If your plan depends on the market being up in years 1 through 5 of your retirement, rewrite the plan. That is not risk management. That is optimism. Second, map your income sources to sectors. If more than 30% of your retirement income is coming from a single sector, say all tech-adjacent covered call ETFs, you have concentration risk disguised as diversification. Real diversification means pipelines, real estate, business lending, and infrastructure all in the same portfolio with different economic triggers for stress. Third, require dividend growth as a condition of ownership. A flat 7% yield that doesn't grow is worth less than a 5% yield, growing at 5% annually. In 10 years, the growing one has outrun inflation. The flat one has been quietly eaten alive by it. The market might have a great year in 2026. I genuinely hope it does. But your retirement income plan should not depend on that hope. Build a machine that runs in